Hey everyone. Today I just wanted to show you how I don't go out and buy stocks outright. I normally sell cash secured puts on them and try to get assigned. Now, here's an example. Very, very quickly, I'm looking at this is my paper trading account. So just bear with me and I'll explain everything um, around this strategy. Now, here's an Apple stock option chain. Look at the volume and open interest on in these columns here. They're great. It's a very liquid stock. So why not sell a put, collect some premium, keep it in your pocket, and then try to get assigned. So, by doing that, you will already reduce your cost basis on the stock rather than buying the stock right now at 215. That's where it's trading here, 215. Rather than buying it outright, why not just sell at a strike that you like? So let's say I'm thinking now. Look at the chart as well. Apple has dropped quite a bit. It has ticked up from that point. So at 200, it was at 200, on Monday, or maybe even last week, 85, and now it has ticked up. Fine. I still want the stock at 200. That's what I think the intrinsic value is of the stock, the fundamental value. So I will sell a strike. I will sell a cash secured put at that strike, and then just wait for it to get assigned, and then I will hold the stock forever or for however long I want it. When my profit target will hit, I will get rid of that stock. Anyway, this is how you do it. Look at the bid ask spread here. It's very, very tight. It's only 4 cents. This is basically nothing in the option world. So I'm going to go right click on the $200 strike, and I'm going 42 days out so I can collect some premium. Now, here's the downside of this strategy, that you have to wait for the stock price to come to you before you get assigned. Again, if you want the stock right now at 215, you can go ahead and buy it. But I don't ever do that. I try to sell a put and then wait for the stock to come to me so I can get the stock at my price, not what the current market price is. Anyway, that's my rationale. You can do however you want it. But here's the cash secured put strategy in Apple. 42 days out, that's my sweet spot between 30 and 40 and 45 days. Right click and then go sell a single. Go sell a single on this. Fine. Then take this and analyze the trade. Here's how you analyze it. Now, I need to change this. And remember, each option contract will control 100 stock of Apple. So you want to make sure, do you want to buy in multiples, like $100 increments, or you want something smaller? If you want something smaller, go out and buy outright stocks. Here, when you get assigned, you will be assigned 100 stock for each option contract, which is within my risk budget, so I don't mind doing that. Now look at this probability of profit. So here's the 80% mark that I normally look at. Sorry, I didn't talk about the deltas. I'm going 20 deltas here. Usually my sweet spot is 16 and 17, but here, because I also want I also want some heavier premium in these from these options, I will go 20 deltas because I want to get assigned anyway. And look at the implied volatility here. It was 43 when the route started on Monday, and then it has dropped to 30 now. So we still have some ways to go before it goes down to its average of 20, I would say. Fine. So we still have some IV contraction remaining in this position. We will make money when the IV goes down. We will make money when the stock goes up. Now, here are the Greeks. These are the main Greeks that I look at. You should open up your price slices and then go here. First of all, make sure you have a break-even point at the same date. The top date here should also be the same. Otherwise, your charts will be messed up. If you want to see that, let me show you. If I go and select an August expiration, let's say 25th, this is how the chart looks. It doesn't even work. So you have to make sure that you select the same expiration as your break even is, as your break even slices are, and then and this has gone to 2023, by the way. So I need to make sure I bring it back here. Then make sure you go back and select this again. You will get the right number, 79%. I'm pretty happy with that. Also open up at minus 10 and 10%, plus 10. Meaning, what does that mean? If the stock moves plus 10, this is what your Greeks are going to look like. This is how much P&L you will make. This is all theoretical, so don't go off this. Always make sure your focus is on the zero line. Like right now, this is where the stock is trading right now, 214.52. And then if it goes up 10%, this is how the numbers will look theoretically. And if it goes down 10%, this is how the numbers look theoretically again. So my line is here. I'm collecting 21 deltas. I'm short gamma because I'm selling the option. My theta, I'm supposed to collect $6.95 each day in this option. Vega, I'm short Vega because my implied volatility is high, and I'm looking for an IV crush, which is exactly what's going to happen when the stock goes up. When the stock goes up, IV contracts, and that's what I'm looking for. So I'm going to change this price. I'm going to set my limit order at 280. Now also look at this. When I do confirm and send, this is what the numbers look like. I will pay 65 cents for this contract. Obviously, you have to pay some commissions to trade options. Nothing for stocks anymore. Your break-even price on the bottom side is 197.20, which you can look at here if you hover over this red line and read the number on the bottom. It's 197. I don't think I have it right on the dot there, but yeah, 197.20, because all it is saying is however much credit you've received, you deduct that from your strike price, and that's how you get your break even. What else? What I wanted to show you. So also make sure you have enough money in your account, because when you get assigned, you will have to pay for the stock, and you will pay for the stock at that strike price, right? So you will pay at $200 strike price if it gets assigned, plus you will keep $2.80, meaning you've already reduced your cost basis by $2.80 if it gets assigned at $200. Right now, you have to put down $2,800 versus if you wanted to buy 100 stock right now, it would have been 100 times 215, and then 50% of that. So these platforms will take 50% of that money down, and then the remaining 50% is margin. And then they will, if you go over your overall net lick in the account, they will charge you for that margin. Anyway, these are the trade mechanics. Let's see. This is my trading account, so I'm just going to put it in. I'm going to put the order in, and then I'm just going to wait and then see what happens. Let's see if I can get filled. If not, I have to lower down the price. Well, I'm just going to leave it there, and then there's no mechanics. There's no risk management here because I want to get assigned, right? So I'm going to sell it. I'm going to sell the option and then just wait for it to get signed. If it doesn't, let's say it keeps going up on me, I will still collect $2.80. Well, I wouldn't collect all of it, but I will look to collect at least $200 out of that option. So from 280, I will collect at least 200 plus some more. If it doesn't get assigned on me, I'm going to go out again in this cycle, in the October cycle, and then I'm going to sell the same thing. Hopefully, it will come to me in that cycle. If it doesn't, I'm going to keep selling it until I get assigned. Now, on the flip side, if you want to get the stock right now, just go out and buy it. Thank you very much.